Quick disclaimer. This video is for educational purposes only and does not provide financial or investment advice. Investing involves risk, and results vary. Always do your own research or consult a licensed professional. The world of investing often feels like a complex, high-stakes game, one that's rigged against the little guy. We see headlines about billionaire hedge fund managers, lightning-fast trading algorithms, and corporate insiders who seem to have an unassailable edge. It's easy to conclude that the market is fundamentally unfair and that the average person simply can't win. But what if that isn't the whole story? What if the primary reason most investors don't achieve the returns they hope for has less to do with a rigged system and more to do with the very human instincts we rely on every day? The surprising truth is, most investors don't underperform the market because the market is unfair. They underperform because they follow strategies that feel right, but simply don't work. Our brains are wired for survival, to react quickly to perceived threats and opportunities. When we see a stock plummeting, our instinct is to sell before it goes to zero. When we hear about a company that's skyrocketing, our fear of missing out compels us to jump on board. We chase trends, we react to breaking news, and we try to predict the market's next move. These actions feel logical, prudent, and even smart in the moment. They are the financial equivalent of pulling your hand away from a hot stove. The problem is, the stock market doesn't operate on the same intuitive logic as our physical world. The very instincts that protect us in daily life often lead to disastrous financial decisions. They cause us to buy high out of greed and sell low out of fear. The exact opposite of the classic investing mantra. The data on this is startlingly clear. Despite decades of profound and consistent market growth, the average investor consistently earns less than the market itself. Studies like the well-known Dalbar quantitative analysis of investor behavior have repeatedly shown a significant gap between the returns of the market indices, like the S&P 500, and the returns the average mutual fund investor actually pockets. For instance, over a 20-year period where the S&P 500 might average a return of, say, 10% annually, the average equity investor might only see a return of 6% or 7%. Now, a few percentage points might not sound like much, but over an investing lifetime, the difference is monumental. Let's do some simple math. If you invest $100,000 and earn 10% a year for 30 years, you'd end up with nearly $1.75 million. But at a 7% return, that same $100,000 grows to just over $760,000. That's a difference of almost $1 million. This isn't a small rounding error. It's the difference between a comfortable retirement and a constant state of financial worry. This performance gap, repeated year after year across millions of investors, represents one of the single greatest destroyers of wealth for ordinary families. It's a quiet crisis, happening in brokerage accounts all over the world. So, if our instincts are leading us astray, what is the right path? How can we close that gap and harness the market's long-term power for our own benefit? That is the central question we will answer in this video. We're going to embark on a journey to dismantle the myths and emotional traps that sabotage most investors. We will explore the psychological biases, like loss aversion and herd mentality, that cloud our judgment and compel us to make poor choices. We'll break down the fundamental principles that have actually built wealth over generations. The incredible, almost magical power of compound interest, the critical importance of diversification, and the discipline of maintaining a long-term perspective, even when, especially when, it feels uncomfortable. We will provide a clear framework for building a robust, resilient investment strategy that is designed not to beat the market, but to the market. This isn't about secret stock tips or complex trading algorithms. It's about a fundamental shift in mindset. It's about learning how to think differently about risk, time, and the very purpose of investing. By the end of this video, you will have a clear, actionable plan to avoid the common pitfalls and align your strategy with the proven drivers of long-term growth, empowering you to take control of your financial future. When we look at the history of the financial markets, one fundamental truth emerges with remarkable consistency. Over long periods, the stock market has demonstrated a powerful and persistent tendency to grow. This isn't just a hopeful theory, it's a historical fact, etched into decades of data. If you trace the performance of major indices like the S&P 500, which represents a broad slice of the American economy, the line trends unmistakably upward. This growth is not an accident. It's the financial reflection of human progress, of innovation, corporate earnings, expanding economies, and the relentless drive to create value. From the Industrial Revolution to the digital age, the market has served as an engine, compounding wealth for those who remain invested in its long-term journey. Of course, this path is never a straight line. It's punctuated by periods of gut-wrenching volatility, sharp downturns, and economic recessions. Yet, history also shows us that for every downturn, there has been a subsequent recovery and a new period of growth. The key takeaway is that the market has always rewarded patience. This brings us to a perplexing paradox. If the market reliably grows over time, why do so many individual investors fail to capture those returns? Why do their personal account statements often tell a story of stagnation or, in some cases, loss, even during bull markets? The unfortunate reality is that most individual investors capture only a fraction of the market's potential gains. This isn't a minor discrepancy. It's a significant and well-documented phenomenon known as the performance gap, or more accurately, the behavior gap. Year after year, extensive studies, such as the landmark quantitative analysis of investor behavior by Dalbar, consistently find that the average investor's returns lag far behind the very indices they are invested in. This gap can represent a difference of several percentage points annually. While that might not sound like much, over an investing lifetime of 20, 30, or 40 years, the power of compounding transforms this small annual gap into a monumental shortfall, often amounting to hundreds of thousands or even millions of dollars in lost potential wealth. It's the difference between a comfortable retirement and a constant state of financial anxiety. So, what is the cause of this costly gap? The first thing we must understand is that this gap isn't caused by a lack of intelligence. The people who fall victim to it are not foolish. They are doctors, engineers, teachers, and entrepreneurs. They are smart, successful individuals who are experts in their own fields. They can perform complex surgery, design bridges, or run successful businesses. They are perfectly capable of understanding financial concepts. The problem isn't a low IQ. It's not about being unable to read a chart or understand a company's balance sheet. The root cause is far more fundamental, and it lies deep within our own human nature. It's caused by behavior. More specifically, it's caused by a series of predictable, emotionally driven behavioral biases that are hardwired into our psychology. Our brains evolved over millennia to handle immediate, short-term threats, like escaping a predator on the savannah. This system, governed by fear and greed, is incredibly effective for physical survival. When we see a threat, our emotional brain, the amygdala, takes over, triggering a fight-or-flight response. This happens instantly, long before our rational brain, the prefrontal cortex, has time to analyze the situation. In the modern world of investing, this ancient wiring works directly against us. The threats are not tigers, but flashing red numbers on a screen. The opportunities are not a sudden bounty of food, but a stock price soaring to new heights. Our brains react to this market noise with the same primal urgency, flooding our system with emotions that compel us to act immediately. This emotional response manifests in a destructive cycle of behavior. Investors buy after prices have already risen and sell after prices have already fallen. They are driven by two of the most powerful emotions in finance: fear of missing out and fear of losing everything. When the market is soaring and news headlines are euphoric, investors who were sitting on the sidelines feel a pang of regret. They see others making money and, fearing they will be left behind, they finally jump in, often buying at or near the peak. Conversely, when the market tumbles and the news is filled with panic, the fear of further losses becomes overwhelming. The instinct to stop the bleeding takes over, and they sell their holdings, locking in their losses and converting a temporary paper decline into a permanent loss of capital. They react emotionally to short-term news, mistaking daily volatility for a fundamental change in long-term trends. This cycle of buying high and selling low is the very definition of wealth destruction. It is the engine that drives the performance gap, and it is the single greatest obstacle standing between most investors and their financial goals. The single biggest reason investors underperform is market timing. They chase trends. They panic during downturns. They constantly change strategies. Over time, this behavior creates a cycle of buying high and selling low. Long-term investing isn't about prediction. It's about discipline. Investors who outperform tend to focus on broad diversification, low costs, consistent contributions, staying invested through volatility. This approach isn't exciting, but it's effective. Now let's delve into what is arguably the most powerful force in the world of finance: compounding. Albert Einstein is often quoted as having called it the eighth wonder of the world, and for good reason. At its core, compounding is the process where your investment's earnings, from capital gains or dividends, are reinvested to generate their own earnings. Think of it like a snowball rolling down a hill. It starts small, but as it rolls, it picks up more snow, growing larger and larger at an ever-increasing rate. Your initial investment is the small snowball. The returns it generates are the first layer of new snow. When you reinvest those returns, your snowball gets bigger, and the next time it rolls, it picks up even more snow. This cycle repeats, creating exponential growth that can turn a modest initial sum into a substantial fortune over time. It's a concept that is simple in principle, but profound in its long-term impact. To truly appreciate its power, let's look at a simple example. Imagine you invest $10,000 in a portfolio that earns an average annual return of 8%. In the first year, you would earn $800, bringing your total to $10,800. If this were simple interest, you would earn that same $800 every single year. But with compounding, the magic begins in year 2. Now, you earn 8%, not on your original $10,000, but on the new total of $10,800. That means your earnings for year 2 are $864. It's only $64 more, which might not seem like much. But this is the crucial starting point of the acceleration. In year 3, you'll earn interest on $10,800 plus the $864. This process of earning returns on your returns is what creates the upward curving growth line that distinguishes compounding from simple, linear growth. A key catalyst for this compounding machine, especially in stock market investing, is the reinvestment of dividends. When you own shares in a company that pays dividends, you're receiving a portion of that company's profits. You have a choice. You can take that money as cash, or you can reinvest it. When gains and dividends are reinvested, growth accelerates over time. Many brokerage platforms offer something called a dividend reinvestment plan, or DRIP. This automatically uses your dividend payments to buy more shares, or even fractional shares, of the same stock. Each reinvested dividend increases the number of shares you own. This in turn means that the next time a dividend is paid, you receive a slightly larger payment, which then buys even more shares. This creates a virtuous cycle, a self-fueling loop where your ownership stake grows organically, amplifying the effects of compounding without you having to invest a single additional dollar from your pocket. The single most important ingredient for compounding is time. The longer your money has to work for you, the more dramatic the results will be. Let's consider two investors. Investor A starts at age 25 and invests $5,000 a year for just 10 years until age 35. They invest a total of $50,000 and then never add another cent. Investor B gets a later start, beginning at age 35. They also invest $5,000 a year, but they do it for 30 years until age 65, investing a total of $150,000. Assuming both earn an 8% annual return, who do you think has more money at age 65? Counterintuitively, Investor A, who invested for only 10 years and contributed 1/3 of the money, ends up with a larger portfolio. Their initial $50,000 had an extra decade to grow and compound, and that head start made all the difference. This demonstrates a fundamental truth. Small, steady returns can compound into significant wealth across decades. The amount you invest is important, but the time you stay invested is paramount. This is why you will often hear seasoned investors say that time the market matters more than the market. Trying to predict the market's short-term peaks and valleys is a difficult, often losing game. But history has shown that over long periods, the market has a persistent upward trend. By investing regularly and allowing your money to remain invested through market cycles, you give the powerful force of compounding the one thing it needs most: time. Your patience is rewarded not by quick, speculative wins, but by the steady, relentless, and ultimately life-changing process of your wealth building upon itself, year after year, decade after decade. Professional investors don't rely on emotions, they rely on systems. They set allocation rules. They rebalance periodically. They ignore daily noise. The goal isn't to predict the future. It's to stay consistent long enough for compounding to work. Most people won't get rich overnight in the stock market, but many can build long-term wealth by avoiding obvious mistakes. Slow, boring, and disciplined often beats fast and risky. The market doesn't reward prediction. It rewards patience. If this video helped you think differently about investing, like the video, subscribe, and comment long-term for the next breakdown.